All right, everybody, welcome to another episode of In the Valley podcast. I'm here today with Corey Hughes at Desert Mountain Appraisal Services. How you doing today, Corey?
Great, thank you. How are you?
I'm doing good, thank you. Thank you for taking some time coming out and hopping on the episode.
My pleasure.
First off, before we even get started into answering any appraisal questions, what you do, how it all works, why don't you tell me a little bit about yourself? You from Arizona? How long have you been doing this? What did you do before? All that good stuff.
You got it. Yeah, I'm not originally from Arizona. I was born in Indiana, but that was very short-lived, and at a young age, we moved out to Arizona. Actually moved back to Arizona. My parents graduated high school locally, Cactus High School. It's on the west side of town. Moved out to Indiana temporarily, and then we ultimately came back. I have lived almost entirely up on probably I would call it the northwest part of town, the Loop 101, 67th Avenue, Happy Valley type
Okay.
of area. Appraising, I have been appraising since 2005. And at the time, let's see, I became licensed in 2007 because at the time when deciding to become an appraiser, there was a 2-year requirement for the apprenticeship previous to licensing, where you had to work with a not only a licensed but certified supervisory appraiser. So basically just a designation this particular appraiser has and is registered with the state and is allowed to take somebody like me under his or her wing and train them over the course of 2 years. And that's basically where you're doing almost everything entirely hands-on.
Did you get paid during that time?
You do, and compensation varies quite a bit, just depending on how much of the workload that you're going to be responsible for at different stages, first year versus second year. Things have they've changed a lot over the years. Like I said, I became licensed in 2007, and boy, shortly after that, things changed. Not just in the Arizona market, but of course across the country, across the world. Really, our economy influenced a lot of different economies. But I saw the rise of the market values at the time, the shortage of homes, the bidding wars, offering 20, 30, 40,000 over asking price. And we just did it again. In 2020, 2021, they were doing appraisal waivers, things like that. But before I get too far ahead, you get licensed, and then at some point, the decision is made to become certified, and that's ultimately what I did. I got certified. There's a big difference between being licensed and being certified. If you're a licensed appraiser, you can appraise anything really up to an estimated market value of no more than $1 million.
Okay.
So obviously things have changed since I was originally licensed. Market values have gone up over time.
Yeah.
Historically, they dipped for a number of years, but they more than rebounded. And it's not uncommon to appraise houses in excess of an estimated market value of $1 million. That's where you need the certification.
Okay. So anything over a million.
Anything over $1 million, yep. Anything residentially, it can't exceed 4 units. Otherwise, you get into commercial appraising.
Which is a different license.
That is another animal in and of itself.
Okay.
Additional schooling hours. You need to work under a commercially certified appraiser. And that's probably about as far as you're going to take it.
Cool.
And then your experience is a wide range. It could be agricultural, it could be small business, any number of reasons to have a commercial appraisal ordered.
Okay, cool. So when you became an appraiser before the crash.
I did. Yep.
So why don't you give us a little bit of insight of how the appraisal systems worked before the crash and then how it works now?
Yep, easy enough. Yeah, so I saw that steady rise in the workload, market values, the demand. There was a lot of laxed lending requirements at the time that allowed for very easy approval, very easy to qualify, stated income, no money down. There were a lot of things that allowed for the real estate market to flourish the way it did, to the point where there wasn't enough oversight and it did what it did. In the end, it ultimately crashed. Basically, we saw this rise, and at the time, the appraiser had a direct relationship with, I would say both the real estate agent and the lender, the loan,
The buying agent.
a combination of both the seller's agent and the buyer's agent,
Okay.
really. Everybody worked together in that transaction, the appraiser, the realtor, and also the loan officer. And the real estate agent, oftentimes working with that loan officer, could potentially influence who that loan officer would hire to do the appraisal based on past experiences.
Because they got to pick their appraiser at the time.
At the time, the lender got to pick the appraiser. And that's how we acquired work. It was the old saying, pounding the pavement. You'd go out and you would sit down, meet with lenders. You're sitting across the desk from them, or maybe you're taking them out to lunch.
That's the way you built your business.
That's the way the business was built. You had those direct relationships, and you would have a number of different relationships with a number of different loan officers. That way work was funneling in from a number of different channels, basically. And I think it's one of the things that influenced what we'll call the ultimate demise of market values at the time. And that's when things were modified after the crash, and we'll get into that. But a lot of the blame was placed on what was called the collusion between loan officers and real estate appraisers at the time. It was that fear that if I don't make this one deal work for this particular loan officer or mortgage broker or lending institution,
you're not going to get that job again.
I'm not going to get any more work. You felt as though you are only as good as the last deal that you make work for somebody in this industry. And there were indirect ways and direct ways of stating that on the part of the loan officer. It's like, Corey, hey, I send you 30 appraisals a month. I really need you to make this one deal work. We're off by 5,000, 10,000, 20,000. How can we get this one to appraise at whatever the contracted purchase price is? And
yeah, that persuades you for sure.
It did. It was
a lot of pressure.
A lot of pressure, very uncomfortable position to be put in, because you want to continue to get work from this institution or this individual or this one company. At the same time, if you're doing these things and often you're stretching these values, at some point you may not have any work because your license is taken away from you, because there are standards in place, the Appraisal Foundation, the Appraisal Board, your state licensing appraisal institution, and these things are looked at often. FHA orders appraisal reviews all the time, just as a way of doing quality control. Lending institutions, they order reviews on appraisals that have been done to make sure that they're not lending on something that really wasn't worth what it was said to be. Even though we wanted to make the deals work to continue to get work, getting work at some point may not have even been an option, because you're not an appraiser anymore.
No, it makes sense. It makes sense. And with all that being said, that's the exact reason why they changed it the way it is. And I think the way they changed it is great. And it makes a lot more sense, especially when you look at it like the way you just said, how it was just normal for you guys as appraisers to go speak out to lenders. That's the way you built your business. And it's very easy to be pressured into all of those things. So I'm glad the way the government, whoever did it, made it the way it is today, because it makes a lot more sense.
Yeah.
So with that being said, can you briefly explain what you as a home appraiser entails? What do you do? And why is your job important to the real estate industry?
Yeah, absolutely. Number one, the job and the appraisal assignment is important to the lending institution. They want to make sure that the funds that they're lending are secured by a property that is in fact worth what we say it is. So that if unfortunately somebody is not able to continue making that mortgage payment, they're able to take back the property, sell it on the open market, and ultimately sell it for what they loaned, possibly more, possibly less, just depending on market conditions at the time. That's depositor money. When you go to any type of lending institution and you borrow funds, you're essentially borrowing my money, your money,
Yeah.
The deposits, our paychecks that we take and we put into that financial institution. If you're paying cash for a property or a house, don't order an appraisal. By all means, you don't have to. It's entirely up to you. Maybe you don't care what it's worth because you want the property that bad. And if you're paying cash, that's your choice. But when you're borrowing somebody else's money, the appraisal is required.
Yeah. And it just makes sense. If you were lending money to anybody, you would want to know, am I getting paid back?
Yep.
What am I lending you the money on, etc. So it makes sense. And I think you pointed out a great point where a lot of people think they need appraisals. So if you're paying cash 100%, if you don't care what your value is, let it ride.
Yep.
Go ahead and buy the house. You don't need appraisal. You probably speed up the whole closing process.
Absolutely.
So what are some key factors when you're determining the value of a home? I know you as an appraiser, I don't personally usually talk to you, maybe to give you the code on to get into the house as the seller's agent, but that's about it. The buyer, the seller, they usually don't talk to you anymore anyways. So how does that work in today's world? What are the factors? How do you say a value is worth this much and it's not worth this much?
Yeah. You got it. First of all, there's a lot of things that I'm looking for, and it starts with the order form. So when that order form comes over from the now appraisal management company, who is contacted by the lender to have an appraisal ordered for the purchase or refinance transaction, the appraisal management company then picks from a pool of appraisers that are on their approved list, and they'll assign that appraisal at random or based on that appraiser's estimated turn time or maybe how competitive their fee is. I'm looking at the order form, and we need to first determine the type of transaction. Is this conventional lending? Is this FHA? Or is this VA?
Why does that matter?
It matters because the property inspection is different from one to the other. More specifically, and especially with FHA and VA, in addition to the actual appraisal process where we are determining the estimated market value of the property, we're looking for deficiencies, almost like a very small scale home inspection. Okay. I do a lot of FHA appraisals, and in addition to valuation, I'm looking at deferred maintenance. One of the biggest things that is oftentimes an issue would be your exterior trim on the home. And so this is good information for the listing agent.
Yeah, someone going to sell a home.
And also the buyer's agent. The listing agent may need to disclose, hey, the home is, in need of some repairs. If you're bringing a buyer to potentially purchase this property, there is the potential that it won't qualify for FHA or VA funding. We may need to do something conventionally speaking. So your fascia board on the exterior of the home, it needs to be, it's an exposed wood, so it always has to be treated. It can't have chipping or peeling paint. There can't be any kind of wood rot. The trim around the door frames, the garage door. You're also looking for, and we're not engineers, we're not structural engineers, but at the same time, if you see foundation cracks in the exterior stucco or block walls, it's potentially something that has to be pointed out on an FHA or VA appraisal. Then when you go into the interior of the home, and this is, continuing with the inspection part of the appraisal process, all utilities have to be on. So water has to be on, the power has to be on.
What's the reason for that? Just to know that it works?
Well, number one reason, we have to test the appliances.
Okay.
FHA wants to make sure that the appliances are functioning. The oven, as an example, the dishwasher, those are questions asked on the appraisal report. You're also looking for the existence of smoke detectors. They want to make sure, and this goes back to a lending requirement. This is how the lender is, and also FHA, because they insure the loan, this is how they protect their investment.
Okay.
Smoke detectors help to mitigate risk, right? So we need to make sure that we have properly working smoke detectors. So if there is a fire, we can maybe isolate it to that one room. It's called to attention sooner than later. We're putting the fire out and maybe fixing just the kitchen and not rebuilding the entire house.
Yeah, here I thought you guys just went in, measured, and left.
Not always.
So that's funny because it makes sense. As a home inspector, they don't turn in that report to the lender. So you as the appraiser, you guys are returning that report to the lender,
Yes,
which is why you have to have that mini inspection.
that's right.
Okay.
Yep. And a lot of those things, some of those things are actually changing even as of late. They're now looking for when you have a gas supplied to the residence and there's a gas fired appliance. So your water heater, as an example, if that's on the interior of the home, in some older homes, you still have the water heater in a hallway closet, your cooktop. They want to make sure there's the existence of CO detectors as well. As of late, this is most recent. Something that's been asked of me is the water heater in the garage. Is there the presence of a temperature pressure relief valve? They want to make sure that's there. It appears to be installed appropriately, because if not, and there is excessive heat and pressure and that tank blows,
Is it going to flood the house?
is it going to flood the house? Is it going to blow through the roof? And now we're replacing drywall and roof trusses and roof tiles or shingles and things like that. So again, it's risk mitigation. There are certain things in the appraisal process that we're inspecting, just putting their minds at ease, basically. Okay.
Yeah, them meaning the lenders. Makes sense.
Correct. The lender. Yep. Yep. And then, like you mentioned, once I've scanned over some of those items and I have to snap a picture of all of those things, those all go into the appraisal report. And then we measure the exterior of the home. In Arizona, we are only required to basically measure the exterior or the perimeter of the home. We do not have to account for loss of square footage because of the depth of the exterior walls, the separation of rooms inside of the home. So you have those interior walls that do ultimately take away from livable square footage, but it's just small to the point where we're not asked to account for those types of things. We measure the exterior of the home to determine its footprint, its overall gross livable area. That's one of your biggest indicators of value.
Yeah.
We measure the garage, your patios, and those things are measured. The gross livable area has more to do with valuation. When we measure the patios and the garages and things like that, it's a valuation factor, but it's also, we obtain those measurements in the event that we're asked to complete the cost approach.
What is the cost approach?
So it's another form of valuation. Most of these appraisals, we are basing our opinion of value on what is called market value. And we'll certainly get into that. And market value is determined by similar homes that have sold in what we call the defined market area.
And that's the kind of like the main way you guys determine value, correct?
It is the main way that we determine value. The cost approach is used to determine what it would cost to reconstruct that home in as-is condition, taking into consideration physical depreciation based on its effective age. It looks at the land value. It calculates a price per square foot of gross livable area, price per square foot of a garage, because obviously it costs money to build the garage, the patios. We complete a cost approach to value, to market value on every new build appraisal. It is a requirement on every new construction appraisal. In addition to doing the market value approach, you're doing the cost approach, just because it's brand new construction. So they want to know, does the cost approach to reconstruct this home, does it fall short of the estimated market value of the home based on sales? Does it support or exceed that? And it just gives them an idea of costs and where the market is at and how those two numbers basically correspond with one another.
Okay. Yeah, that makes sense. I guess also when determining those factors of how you determine value, I think us as agents, us as buyers, us as sellers, they only know one way, and that's my house comparing to this house, my house comparing the house down the street that sold for $50,000 more. Why is my house only worth $400,000? That house is worth $475,000.
Right.
My house looks nicer than theirs. So why don't you answer like some of those misconceptions that you get all the time as an appraiser? I'd imagine that's probably one of the biggest, but
one of the biggest misconceptions, and this I hear often, is they will derive their opinion of market value based on a price per square foot. And it's a price per square foot that they've derived from that market area, homes in that market area. But we don't know what homes they're looking at. When they pull this number out, they're basically dividing what it sold for its square foot, its gross livable area by what it sold for. And they say, okay, my house is $300 a square foot too. We don't look at that as appraisers because you can't look at the overall price per square foot. There's a lot of things that go into that have to be backed out. Okay, when you're looking at what this property sold for, $500,000, there's a number of components that ultimately allowed for the number to get to 500,000. There's the value of the land. There's the site improvements. Okay, so all of these things have to be backed out, and then you're left with whatever that number is left over, and that's the price per square foot of the home itself, your gross livable area.
But I just redid my bathroom.
Yep.
But I just redid my kitchen. So that house that sold down the road and their kitchen is shit and their bathroom is shit, how come their house is worth more than mine? That's what people assume. That's how I feel like, as a misconception, that's what they're asking. Hey, why is it only worth this much when my house looks nicer than theirs? And I think that's, again, I know I'm going, I know there's tons of variable factors that get you to that. But I think by just allowing the people that think this and this, if we can just give them more of a realistic idea of, hey, there's more to it than just that.
What I would ask people to do, real estate agents, sellers, because there's a lot of bias that goes into, like you were mentioning just now, that we take our homes very personally, and we have a tendency to think that we are superior than the neighbor's house that sold down the street. I am better than that because of the bathrooms, the kitchens, the pools, all that. And that's where the appraiser comes along. And what I'm going to do is I'm going to find what I consider to be a like product. So first and foremost, we can get really basic. If I'm appraising a single story home, I'm going to want to look for homes that have recently sold that are also single story. And in a lot of these neighborhoods across the valley, they're very cookie cutter. We can go.
They all look the same.
You can go into any master planned community. They call them planned area developments, where they do thousands and thousands of homes. There's 3 different builders. They all build a very like product. A lot of the times you can even find comparable sales of the same floor plan. And that obviously is ideal because it is identical to what you're now going to list and to ultimately appraise. So we want to look at single story homes. We want to look at as similar of a square footage as possible, because again, that's one of your biggest indicators of value. One of the rules in appraising is we will typically go 20% in either direction.
Okay, so, up or down?
Up or down.
The square footage.
Yeah, so if you're a listing agent, look at that. So if we're 2,000 square feet, you can go all the way down to, let's say, 1,600 up to 2,400. That is your range. You're going to stay within those parameters.
That's good to know, especially as an agent.
Yep. Yeah, you don't want to go look at something that's 3,000 square feet and then do the whole price per square foot thing. That is a different market. It's not as easy as now making market value adjustments, because you can't make market value adjustments when you're trying to compare 2 different markets.
Yeah, that makes sense.
You're within the same market when you're looking at a similar or like product. And so 20% in either direction on the gross livable area. We're going to look at things like garage count, especially in Arizona. It's a big deal. Covered parking is important.
Tons of value.
Because of the temperatures that we have here, security reasons, storage, things like that.
Just the sun beating on your cars or whatever.
Yep, absolutely. A lot of the new construction homes, especially, I'll call this on the west side where I'm at, they're building the attached and detached RV garages.
Yeah, sweet. I love those homes.
Those are becoming increasingly popular. They're in high demand. And again, that's a different market. If you want that RV garage, you're going to pay for that RV garage. So you're only going to want to use homes that have those RV garages as comparables. Okay. Or at least do your best to try. And even if you can't find, when you're doing an appraisal, we are required at the very least to put 3 comparable sales in that appraisal report.
Okay. Does it matter how far, sorry to cut you off, does it matter how far in distance did they sell, the age of the home? Are we all trying to get, just like how you said, how you can go 20% in either direction for square footage? Is there a rule that you guys go by for age, that kind of stuff?
I'll get into the question about age, because physical age has less to do with it, and it's more about the effective age of the home. So we'll talk about that. Distance is definitely something that we look at. And Because of how dense some of these neighborhoods are, there's, again, this unwritten rule that we shouldn't really be expanding anything beyond 1 mile.
Yeah. And yeah, that makes sense.
And if I'm going beyond 1 mile, it's like, why? When I have sales within the immediate neighborhood, am I now just trying to make a value? So that's a red flag. We want to stay within 1 mile. Right now, one of the lending requirements, because unfortunately, most of our markets across the valley are slightly declining. And because it's often on an appraisal report that we are check marking that box that says declining, that the lender wants 2 of those sales in the past 90 days.
Okay. So 90 days is the
90
time
days.
frame. Okay.
Yep. We can go back 6 months.
But 2 out of the 3 need to be 90 days.
2 out of the 3 need to be 90 days. That's going to be most representative of what the market is doing now and in that particular area. And that's unfortunately one of the things that I come across when I am provided, because I do work with a lot of agents. Like you mentioned earlier, if I need to get into this property, I am getting on the phone with typically the listing agent.
Yeah.
Because I need to extend that courtesy to let him or her know that I need to get into this property. If it's occupied, extending that same courtesy to the sellers to allow for that time for me to get in there and take my measurements and photos. And I've got to go in every room and things like that. It almost feels intrusive at times. We're talking to the agent to make these arrangements. And I always, as an appraiser, and I think this is one of the things that has differentiated me from others, I welcome those conversations. I welcome the comparable sales that they used to consider their list price.
And that's how we met.
Yep.
By you calling me, because one of my houses that I listed, my personal Airbnb.
Yep.
And you had called me, obviously, to get in to inspect it, but then obviously there was an issue. And I think that is what makes you different, which is why I brought you the podcast, because
Thank you.
You don't necessarily call me to say, hey, we need to make this better. You call me to say, hey, this is what I found.
Yep.
Tell me what you found on how you got your list price, and then we can go from there. But now that I just learned that stuff right now of 20% up and down, you go by physical age, or not physical age, but the effective age,
Right.
All these things going back in the mile, no more than 6 months. I think all those things are to consider and now know when being a listing agent.
Yep.
Hey, when I go to make my list price or suggest a list price to my sellers, I need to consider these things before giving that price.
Yeah, and show them the sales. These are your neighbors. And I always look in the immediate subdivision first. Every one of our subdivisions has a name: Hidden Manor, Fletcher Heights, whatever it's called. There's a number of different, and the MLS system that we use to pull comparable sales and listings allows you to isolate your market area by the name of its subdivision. We're always starting directly in the subdivision because that's where I'm going to find the same builder, right? The same neighborhood.
Same floor plans.
Same floor plan. Why are people in here? Maybe there's some parks. Maybe there's a school built into that subdivision, and that's why people are drawn. Their kids can safely walk and ride their bikes to school. Okay? It's a convenience thing.
Or those RV garages that you mentioned.
Or the
those
RV garages.
Aren't built in any random community. Usually they're built in only a certain community, then they go another community. It's easier to find those.
Yeah, absolutely. And so you'll look at best case scenario, you're going to find 3 similar sales that have sold in the past 3 to 6 months. You're going to sit those out in front of your client, and you're going to say, look, this is a single story home. It's 1,800 square feet, whereas your 2,000 square feet, the adjusted market value of this property, let's say it sold for $500,000, is going to adjust up because it's inferior in that it's 200 square feet smaller. So we make a market adjustment for that price, that difference in square foot. Let's say you did, $50 a square foot. And that's another thing. That's the market adjustment. Values in the area are $300 a square foot. That's everything. That's the land. That's the site improvements I was talking about earlier. We're talking about making a market adjustment just for the difference in square footage now.
Okay, so that's why you don't go for the whole square footage amount. That makes sense.
That's correct. Yep. Do you have a pool? Do you not? That's a big thing in Arizona too.
Yeah.
Okay. We're 120 degrees in August and in September, and people really do enjoy their pools.
Oh, before we move on, I want to know that question.
Okay.
Do pools really bring value to your home here in Arizona?
I believe so.
Okay.
I've never made a downward market adjustment. I've never seen a pool as a negative thing before.
Okay.
And again, it's as simple as looking at what the market is doing in that area. You're going to look at homes that have sold with pools and without pools. And 9 times out of 10, that house is typically selling for more than a home without pools if it's truly a like product.
Yeah.
Now, it may have a pool but sell for less than a house without a pool, but what are those other variables that are influencing why that house sold for less? Was it dated? That's a big thing too. People are willing to pay for a turnkey product nowadays.
Yeah.
And if a home is completely renovated, updated, remodeled, whatever word you want to throw at it, they command a higher market value.
For sure.
So
Yeah.
you've got to break those things down. That's why it's important as a listing agent, when you're working with your clients, you're going to go in obviously and look at the house. Okay. It's 10 years old. It has granite countertops, modern finishes. It has a pool, a 3-car garage. We're 2,000 square feet. We're single story. We have front and rear yard landscaping. We have covered patio areas, 2, 3 bathrooms, 3, 4 bedrooms. And you want to find those sales.
Okay.
And you will. They're out there. And I think when they really try to find the most like product, they're going to realize that those values aren't too far off from one another. You may have one that sold for $500,000, $510,000, $520,000. This is not rocket science.
Yeah,
when
exactly.
we're estimating, when you really understand the appraisal practice
And when
how
you
we
don't put any emotion into it.
there you go.
I think that's
Yes.
where listing agents, buyers, sellers, that's where they go wrong. Is, oh, my house is nicer because I did this and this, but it's because you've been there for a certain amount of time, or you have this emotional attachment. But if you just look down, look at the numbers, look at everything we're going through, it's worth this much.
It's definitely a responsibility that the listing agent has to their client, and that's education. In my opinion.
Keeping it real too with them.
Keeping it real, absolutely. I understand how vested you are in this property. You've put a lot of blood, sweat, and tears into it. I understand that. I respect that. I get it. But here are 3 homes that are very similar to yours, and this is what they are selling for. How I'm going to be able to sell yours for $25,000, $30,000, $40,000 more, I don't know how I'm going to do that. It's one of those difficult conversations, and that's where the listing agent, in addition to educating them, can't always be as agreeable as they are at times. And I do understand that position. Boy, there is a commission on the line. I don't want to lose. I don't want to lose this listing. This is an opportunity for me to do a good job, get more referrals.
And the agent has a lot of pressure on themselves too.
Absolutely.
It's, hey, I want to list for this price, and can you list it for me for a 1% commission, 2% commission? It's hard sometimes for the agent to just say, sorry, no, I can't do that, and this is what we need to really realistically list at. So it makes sense.
And if they do, there needs to be a hard conversation and just clear expectations. I don't know that we're going to be able to get an appraisal at, let's say, $550,000 when all of the other homes are selling for, like the example, $500,000, $510,000, $520,000. We can go ahead and list it at $550,000, but I think that you're going to see that you're not drawing in as much of the market because there are other homes that are listed right now. The principles of substitution. If I can get this for this, why am I going to buy that for that?
Makes sense, which actually brings me to my next point. So you mentioned it earlier, saying in 2021 and I would say a little bit of 2022, maybe.
Until they raised interest rates in March.
Yeah, it was wave appraisal, wave appraisal, wave appraisal.
Yes.
And now, how has that really been a hurdle for you appraisers now? Because now you're going to, I know for me as a listing agent, when we first approached 2022, I went back 6 months ago, like you're saying, I'm seeing a house worth $100,000 more that sold, but now one that's listed maybe $60,000 less, and it's sitting on the market.
Yep.
So how has that crazy market now going back down to our market where it is today, as you said, it's going towards a downturn. How has that affected you guys as appraisers and made your jobs that much harder?
I don't know that it's made it harder. It's just differences in the market that you now have to account for. And one of the biggest things in the example that you're talking about is it's going to be a time adjustment. So we'll look at that 6 months ago when there's economic influences there too, interest rates. Because interest rates were lower, your purchasing power, your buying power was stronger in that I could qualify for a higher mortgaged amount and still benefit from a lower monthly payment. Whereas now interest rates are going up, so my purchasing power has gone down. I no longer qualify for what I wanted to pay for that house. And so that's one of those economic influences that drives those market values down. So in addition to making time adjustments 6 months back to today, we're going to look at what's active on the market, what's pending, what's contracted on the market. Even though we can't base our estimated opinion of market value on what is actively listed, because you can ask anything you want for your house, it's ultimately what they've closed and sold at. We can make a comment in there that says, listen, even though my comparables after time adjustments have adjusted higher than my contracted purchase price, we can see a trend in the market area. Things are unfortunately declining. And as evidenced by comparables, whatever, 6, 7, 8, 9, and 10 that I've provided that are currently contracted, I've talked with the agents, and to account for those market influence, they are accepting counteroffers now that are less than what those houses sold for 6 months ago. Whereas before, like you said, we were doing appraisal waivers, and those appraisal waivers, that was nothing more than just paying an overinflated price above and beyond even what market value was then. If it was a $500,000 house supported by $500,000 sales, but you signed an appraisal waiver agreeing to pay $540,000, you just paid $40,000 over market value. That's not a true comparable property. That's not a comparable sale.
Okay.
That was a motivated sale.
That's good to know for people that when they're running their comps or thinking about even listing their home, because all they see is, oh, this house sold for this much at this time, I'm going to list it for this much.
Yeah. Look at and the agent can see this information. You look at what the home was originally listed for. If the home was originally listed for $500,000 and sold for $550,000, that is a phone call that needs to be made, because unfortunately, as an appraiser, when we're pulling comps, I don't know that an appraisal waiver was signed. That's not disclosed anywhere. I can't see the original contract from that sale, that property sale. So there's more due diligence involved. It's more than just looking what's on paper on the MLS and Maricopa County records, or Pinal County, wherever you're appraising. It's getting on the phone with the agent and having an in-depth conversation. Did you originally list below market and
on purpose?
On purpose,
just bid wars.
Exactly. No, I priced it right where the comps were in the neighborhood, but because at the time there was a shortage of homes, the buyer signed an appraisal waiver and at $550,000, whatever, and it only appraised for $500,000, which is where the comps were at, but they had to come in with the difference.
Okay. See, and that's something good to know, because I think, especially me as an agent, I didn't know that. I thought it was just like, hey, you take whatever it is sold previously. Yes, of course, I see what it was listed for, what it originally went under contract for, etc. But I didn't know you guys as appraisers look into that. Do you guys also see, especially now where the market's kind of trending downwards, are you guys taking account for seller concessions?
Yes.
Okay.
Yeah.
And how's that kind of working for you guys?
Because the seller concessions now are typical of most markets.
Yeah.
And so you're not having to make these big adjustments for seller concessions because it's typical across the board.
Okay.
And when you can see that in some of the public remarks on the MLS. It's not disclosed anywhere technically. And again, that's where you need to get on the phone and have a phone call with the listing agent or even the buyer's agent. Either one of those parties is going to know, because it has to be discussed on both ends. But what did the concessions look like? And anything up to 3, possibly 4% right now is normal. So if you're within a concession that's somewhere between 1 and 3%, I'm not going to make a dollar for dollar adjustment, because that range is considered to be typical. Maybe they, were a little more willing on a Monday than on a Tuesday and gave 3% instead of 1%. You're not going to sit there and necessarily nitpick those apart.
Yeah. But the 4 to 6% range is pretty significant.
That's very significant. That's not typical of the market. And when it's not typical, you need to be making the adjustments, the market adjustment for the difference between the two.
Okay.
So for example, if they gave a really favorable concession, but as a result sold the house for a heck of a lot more to offset or account for that generous concession, that comparable sale would likely adjust down
Okay.
because they were given so much on the back end, it pumped or inflated the purchase price of the home.
Okay. That makes sense. And I think something else that I want to touch on shortly as we wrapping some things up here is when a lot of my clients are investors. So when we're going to appraise investor properties and rentals, etc., how is that different than appraising a normal single family primary residence home?
When we appraise what we would call that an income producing property.
Okay.
So the lender would then be required to ask for an appraisal that also, in addition to accounting for the property's market value, but also looking at the income approach to market value. Like the cost approach, where we're looking at the cost to construct, the income approach to market value is the value of a home based on its income producing potential.
Okay.
Right now, we really only have the ability to look at long-term
This is exactly what I wanted to touch on.
rental income producing properties. When we get on the MLS, that rental pool that you see on the MLS is typical of your permanent renter.
Yeah.
The long-term
1 year lease.
1 year lease, they're going to renew it the next, you'll worry about it then, you'll negotiate it then, but it's 1 year at a time. I do not have the ability to look at these Airbnb ones, and those are becoming increasingly popular. And the income potential on those properties is substantial in some markets.
Yeah, which is hard to determine the value though.
Yep.
Because if you have a house, for example, a house in Scottsdale that long-term rents for $2,500, $3,000 a month, but I have an Airbnb in Scottsdale and it produces $8,000 to $10,000 a month in gross revenue.
Yep.
So how is that even a comparison? And when I go to buy this house, and a lot of things, I'm sure you're seeing it just like how we met. I listed my house fully furnished as a turnkey Airbnb. So they're purchasing it for that reason, knowing that they can make $7,000 to $8,000 a month in gross revenue. But when I go to order an appraisal as a income appraisal, the lender goes and orders it. In my opinion, is throwing things off.
It does. I understand both sides. I really, really do. A lot of it comes down to risk, and the lender I don't know that they can make that decision based on short-term rentals. It's very unstable. It could be a seasonal market.
Yeah.
Much like when the Super Bowl came to town, when Barrett-Jackson comes to town, when the Waste Management Open comes to town, those Airbnbs do especially well. They even get a premium.
Yeah.
It's like Uber on holidays. They get a premium.
Hard to determine that average, what is the average for the entire year? Because in Airbnb space, every Airbnb market has a seasonal market.
Yeah.
Here, summers are dead.
Yep.
Summers are slow. Nobody wants to come visit here because it's during the heat. But we get our beautiful weather come fall, winter, and spring. Airbnb guests are killing it out here.
Absolutely. And I think one of the things that is most important to recognize, and you mentioned it, these are investor properties.
Yeah.
Listen, it costs money to make money. And if you're an investor and you know what the income producing potential of this Airbnb is, but it only has an estimated market value of, let's say, $500,000, but based on the numbers that you guys are discussing, because it's an income producing property and does so well, you're wanting to sell it for $600,000. That's where the buyer has to come up with the difference in appraised value versus what you guys have contracted its purchase price at.
And I'm now seeing those Airbnbs on the market being marketed as commercial properties, saying, hey, this property is bringing in $8,000 a month and it's for, I don't know, $800,000. We're selling it at X cap rate. Because now, as a true investor, like you're saying, they can come in and say, hey, I can take my same $160,000 down payment for the $800,000 house and I can go buy it, maybe buy somewhere else. And can I get the same cap rate as I can with this house? If not, then now this house looks a little bit more attractive. But after putting that $160,000 down, all they care about is the appraisal value going to come at least to whatever the loan amount is after my down payment.
Yep. And that brings up a good point. If they're listing it or marketing it as a commercial property and there is the potential for commercial lending, then there is the potential for an estimated opinion of market value or income producing potential higher or greater than as a residential use. And in that situation, you're going to hire a commercial appraiser who has knowledge of how to account for those cap rates and things like that. But even then, commercial lending, very strict underwriting guidelines.
Oh,
And
super strict.
You're still coming in with
Heavy amount of down, usually 20, 25, sometimes 30.
You're still coming in with quite a bit. So either way, when it comes to the income producing properties, not so much your long-term rentals, but the Airbnbs, it's definitely an area of opportunity that this industry has. And I think as time goes on and the lenders become more comfortable or familiar with it, it's I don't know, take cryptocurrency as an example, just how it's evolved and how it's being discussed in the government sector, the Treasury Department, things like that. The lending institutions too, I think, will probably explore how we can accommodate these transactions based on their earning potential and how that impacts what the opinion of market value should be, which is greater or more so than a residential property right next door that is going to be occupied by a family.
Yeah, it makes sense. It makes sense. And I think maybe eventually they will come out with some sort of appraisal for Airbnb, but just know if you are looking to purchase an Airbnb, they're going to be taking the normal income approach route. So I think that's good just to let our audience know that. So that way when they're looking, they know, hey, I'm going to have to put X amount of money down. Like you said, you're an investor. It takes money to make money.
Yeah.
So
yeah,
it is what it is. But again, Corey, I appreciate you coming on the podcast. You shared tons of knowledge. I learned a lot. So how can people find you? Go ahead and feel free to talk in the camera. Let them know your name, company name again, where they can reach you, if it's lenders, if it's agents, if they have questions as a buyer or seller. Go ahead. Feel free.
Yeah, absolutely. I'm always welcome to conversations. I guess to be direct, the best way to get a hold of me right now is by email. And that, of course, we can expand on having a conversation from there over the phone. But you can reach me it's Corey, Corey, my first name, Corey, at desertmountainappraisal.com. And feel free to send those emails asking whatever questions you'd like. If you leave your phone number as well, if I think having a conversation would be more meaningful. And most of the times a conversation is warranted just to allow for a better understanding of what you're working with, just like we have here today. I'm more than willing to do that. Absolutely.
Cool. Awesome. Thank you again so much, Corey. Everybody, thank you again for listening to another episode of In the Valley podcast. You'll be able to find this on all platforms. Thank you again. And thanks again, Corey.
Yeah, thank you for having me.
All right.